We just witnessed something that hasn't happened in 14 years. The gold to silver ratio, a metric watched by commodity traders, hedge funds, and central banks around the world, just crashed below 50. To put that in perspective, in April 2025, it stood at 105. Today, around 47. That's a collapse of over 55% in less than a year. If you don't understand what that means, don't worry. Most people don't. But by the end of this video, you'll know exactly why this matters, what happened the last time we saw numbers like this, and what 3 scenarios could play out from here. Before we get into the chaos, let's set the stage. Silver just had one of the most explosive rallies in modern history. In 2025 alone, it surged 147%, rocketing from around $30 per ounce in early 2025 to a peak of nearly $120 by late January 2026. That's not a typo. $120 per ounce. Gold, meanwhile, has been on its own historic run, crossing $5,000 per ounce for the first time ever just days ago. But here's the thing, silver's move has been far more violent, far more parabolic, and far more unpredictable. And then came the crash. On January 30th, 2026, silver plummeted 27% in a single day, the largest single-day drop on record. It's since recovered to around $78 per ounce as of mid-February, but the volatility has left traders, investors, and analysts scrambling to figure out what's really going on. This is where the gold-silver ratio comes in, because while both metals are moving, the relationship between them is telling a very different story. So, what exactly is the gold-silver ratio? It's incredibly simple. It tells you how many ounces of silver it takes to buy 1 ounce of gold. If gold is trading at $5,000 and silver is at $100, the ratio is 50. If gold is $5,000 and silver is at $50, the ratio is 100. The lower the ratio, the more expensive silver is relative to gold. The higher the ratio, the cheaper silver is compared to gold. For most of modern history, this ratio has hovered between 50 and 80. When it stretches above 80 or 90, silver is considered historically cheap. When it falls below 50, silver is considered expensive, or at least overheating relative to gold. Now here's why traders care. This ratio tends to mean revert. It doesn't stay at extremes forever. When it gets stretched in one direction, it eventually snaps back. The question is always, when and how violently? During the 2008 financial crisis, the ratio spiked to 90, meaning silver got crushed relative to gold. But then, from 2009 to 2011, silver staged a historic comeback. By April 2011, silver hit $50 per ounce, and the ratio compressed all the way down to 30. That's one of the lowest readings in the past 50 years. And now, in early 2026, we're sitting at 47, the lowest level since 2011. History is rhyming, but it's not repeating, and that's what makes this moment so fascinating. Let me pause here for a second and ask you this. Do you own any silver? Any gold? Have you ever tracked the ratio? Drop a comment below. I'm genuinely curious how many of you are watching this market in real time, because what we're seeing right now is not normal. All right, let's get into the history, because understanding what happened last time this ratio fell below 50 is critical to understanding what might happen next. The last time the gold-silver ratio dropped below 50 was in 2010 and 2011, during the tail end of the global financial crisis recovery. Back then, silver went from around $17 in early 2010 to a peak of nearly $50 by April 2011, a gain of almost 200%. Gold rose too, but silver absolutely exploded. The ratio compressed from over 80 down to 30 in just over a year. And then, silver crashed. By late 2011, it was back down to $26. By 2015, it had fallen to $14. It took nearly a decade for silver to recover. So what drove that 2011 spike? A few things. Post-crisis stimulus. Central banks were printing money aggressively. Investors feared inflation and currency debasement. Industrial demand, the global economy was recovering, and silver is heavily used in electronics and manufacturing. Speculative mania. Retail investors piled in. Silver became a crowded trade. When sentiment shifted, the exit was brutal. Now fast forward to today. We're seeing a similar setup, but with some major differences. In 2026, silver's rally has been even more extreme, 147% in a single year. The drivers? Central bank gold buying hitting multi-decade highs, geopolitical instability, concerns about US dollar strength, and, crucially, massive industrial demand from the solar panel industry, electric vehicles, and semiconductor manufacturing. But here's the twist. The solar industry is now actively trying to reduce silver usage because prices have gotten so high. According to recent reports, silver now makes up nearly 30% of the cost of producing a solar panel. That's unsustainable. Companies are racing to find substitutes. This creates a very different dynamic than 2011. Back then, demand was rising. Now, demand growth may be slowing because of the price spike. Let's take a breath. I know this is a lot of data, but stick with me because we're about to get into the part that really matters, what happens next. And I'm going to give you 3 scenarios: bullish, bearish, and neutral. Because the truth is, nobody knows for sure. But first, let's talk about the macro backdrop, because that's what's driving everything. Why are precious metals even moving like this in 2026? Let's zoom out. Here are the key macro forces. Central bank gold buying. Central banks around the world, especially in emerging markets like China, India, and Turkey, have been buying gold at historic rates. In 2025, they added over 850 tons. In 2026, JP Morgan expects around 755 tons. That's still elevated. Why? Diversification away from the US dollar, geopolitical hedging, reserve currency concerns, inflation and interest rate uncertainty. Even though inflation has cooled from its 2022 peaks, investors are still nervous. The Federal Reserve's next moves are unclear. Will rates stay higher for longer? Will they cut aggressively if recession risks rise? Precious metals tend to shine in this kind of uncertainty. US dollar volatility. The dollar has been all over the place. When it weakens, gold and silver tend to rally because they're priced in dollars. Recent Fed minutes and geopolitical tensions have created wild swings in currency markets. Geopolitical instability. From trade tensions to conflicts in multiple regions, risk-off sentiment has been a persistent tailwind for gold and silver. Fear is a powerful driver for precious metals, industrial demand for silver. This is unique to silver. It's not just a monetary metal. It's critical for green energy, tech, and manufacturing. But as prices soar, industries are scrambling to reduce usage. That creates a tug-of-war between investment demand and industrial substitution. All of these forces are colliding right now, and that brings us to the big question. What happens next? Before I give you the 3 scenarios, I want to hear from you. Which camp are you in? Bullish on silver? Bearish? Somewhere in between? Let me know in the comments, and if you're finding this useful, hit that like button. It genuinely helps the algorithm. All right, here are 3 possible paths forward. Scenario 1. The bullish case, silver runs to $150 or higher. In this scenario, the ratio continues to compress. Silver outperforms gold massively. Here's how it could happen. Investment demand stays red hot. Retail investors, institutions, and funds continue piling into silver as a hedge against economic uncertainty. Supply constraints bite harder. Silver mining supply is tight. Unlike gold, silver is often mined as a byproduct of other metals. If demand stays strong and supply doesn't increase, prices keep climbing. Industrial demand holds up. Even with substitution efforts, the green energy transition and AI tech boom keeps silver demand elevated. Analysts at Citibank have floated a $150 price target for silver in 2026. Bank of America has mentioned a range as high as $309 under extreme conditions. Now let's be clear, those are outlier scenarios, but they're not impossible. If this plays out, the gold-silver ratio could fall to 35 or even 30, levels we haven't seen in over a decade. Scenario 2. The bearish case. Silver crashes back to $40, $50. In this scenario, the ratio reverses sharply. Silver gives back most of its gains. Here's how. Speculative bubble pops. If silver's rally was driven heavily by speculation and momentum, which it appears to have been, a shift in sentiment could trigger mass selling. We already saw a 27% crash in a single day. That's a warning sign. Industrial demand collapses. If solar companies and tech manufacturers successfully reduce silver usage or find substitutes, demand could fall off a cliff. Recession fears ease or intensify in the wrong way. If economic growth stabilizes and fear subsides, precious metals lose their appeal. Alternatively, if a deep recession hits, industrial demand craters. Dollar strengthens sharply. A strong dollar makes commodities more expensive for international buyers, which pressures prices. In this case, the ratio could shoot back up to 80 or 100, and silver investors would face steep losses. Scenario 3. The neutral case, choppy consolidation. In this scenario, we get volatility but no clear trend. Silver bounces between $60 and $90. Gold holds near $5,000. The ratio stabilizes around 55 to 65. Here's the logic. Demand and supply stay roughly balanced. Investment demand cools slightly, but industrial demand holds steady. Supply improves modestly. Macro uncertainty persists. Markets don't get clear signals on rates, inflation, or growth. Precious metals trade sideways as a result. Mean reversion takes time. Instead of a violent snapback, the ratio drifts higher slowly over months or years. This is probably the most realistic scenario, but it's also the least exciting. Now, no matter which scenario you think is most likely, here are the risks you need to be aware of. Silver is insanely volatile. We just saw a 27% drop in one day. That's not a stock. That's a commodity with huge swings. If you're not comfortable with that level of risk, silver may not be for you. The ratio is not a guarantee. Yes, it tends to mean revert. But timing is everything. It could stay at 40 for months, or it could shoot back to 80 tomorrow. There's no crystal ball. Industrial demand is a double-edged sword. Silver's industrial use is often cited as a bullish factor. But if industries find substitutes or reduce usage, that's a structural headwind. Liquidity matters. In a real panic, both gold and silver can get illiquid. Spreads widen, execution gets messy. That's especially true in physical markets. This is not financial advice. I'm just walking through the data and the scenarios. What you do with your money is your decision. Do your own research. Talk to a financial advisor if needed. So here's where we stand. The gold-silver ratio just hit its lowest level in 14 years. Silver has had one of the most explosive rallies in modern history, followed by one of the most violent crashes. Gold is at all-time highs. Central banks are buying. Industrial demand is shifting. Macro uncertainty is everywhere. History tells us that when the ratio gets this low, something usually gives. Either silver corrects hard, or gold catches up, or we consolidate for a long time. But one thing is certain. This market is not boring. If you're watching this unfold, stay disciplined. Don't chase. Don't panic. Understand the risks. And remember, precious metals are a long-term hedge, not a get-rich-quick scheme. Now I want to hear from you. What do you think happens next? Is silver going to $150? Or is it heading back to $50? Are you buying, selling, or sitting on the sidelines? Drop your thoughts in the comments below. Let's have a real conversation about this, because right now we're living through a moment that traders will be talking about for years. Thanks for watching. If you found this valuable, subscribe, hit the bell, and I'll see you in the next one.